Mike, what is it going to look like when we don't know, likely, the result of the election days or maybe even weeks after?
If it's weeks, it's pretty simple. One word, ugly. And think about 2000. People love that template. S&P was down, what, 7% in 2 weeks, something like that. That's a pretty bad scenario. And bond yields plunged during that time. So if it's a week or more, I think it gets pretty nasty. And I would say, think about Election Day on the Tuesday. If the result is not clear by the weekend, I think markets get very nervous. I've run this idea by a few of our equity folks. They say, no, you're optimistic. We think it's going to be just a day or two. And the markets really get very, very twitchy. So probably a much shorter time horizon than we had back in 2000, but a pretty nasty result if it's not really clear quickly on November 5th.
But 2020 in itself was just a few days. Shouldn't that be the base case?
I think you have to expect a couple of days because there are more delays built into the system now than we had back in 2000. You think about absentee balloting, it's not going away. If you look at the rules for recounts in a lot of states, they allow for a number of days to occur. So in my view, it's going to be a few days and the market can tolerate it. But again, if you get out to that Saturday, Sunday evening time frame and it's 5, 6, 7 days, I think the risk appetite is going to be very, very low. People want to get out of the way.
So define ugly. Risk appetite, meaning for stocks, not necessarily for bonds. That you could see that become the haven again. Is that correct?
That's right. Yeah, I think you'd see a big influx into bonds, primarily into the U.S. short end probably, so 2-year, 3-year Treasury, that sort of thing. Yields go down 30-odd basis points in the 2-year over the span of a week. 10-year yield drops probably 20 basis points, something of that sort. So big rally, big steepener, but again, it takes a few days to develop.